Every time this happens, Bitcoin skyrockets next. Today, the market feels unusually quiet. It is not a bull run, not a panic either. Yet, Bitcoin has been holding above $100k for roughly 6 months. There is no hype, no FOMO, and that might actually be the real signal. When resistance quietly turns into support, it often does in silence. And that's exactly why most people miss it. Oh, before we dive in, a quick reminder here. I have uploaded a free curriculum on Trading 101 explaining how to survive, profit, and manage your trades during this rally phase. You can find the link in the description and pinned comments. If you've recently gotten into crypto through my videos, I strongly recommend watching that before trading. Because today's story isn't about a rumor that moved the market for a day, it's about the structure that builds entire trends. And the key framework I used to read that structure, I will share it with you at the end of the video. If you skip ahead, you will miss the context and end up reacting to the market instead of reading it. So, let's sum it up. This isn't a noisy market that's exploding upwards. It's a slow, steady, and organized accumulation. A structure quietly being built by someone who knows what they are doing. The absence of hype and media frenzy suggests we might still be in the middle of the cycle, not the end. Today, we will break down the evidence behind that and go over key risk checkpoints you need to watch. Then, at the end, I will give you my personal conclusion based on the data. So, stay focused till the end. What moved the market today wasn't data, it was another rumor. There was talk that a major market maker took a massive loss due to exchange issues and was preparing legal action. A perfect setup to spark fear. Except the company itself came out and said it was a complete nonsense. Quote, rumors spread fast and disappear just as quickly. But that's not the point. What people were really afraid of wasn't the lawsuits, it was the system itself. ADL, auto-deleveraging, liquidity overload, exchange bottlenecks, these weren't rumors, they were real vulnerabilities. Here's what is important to understand. Markets do not react to headlines. They react to the confirmation of risks that were already there. The rumor is just the trigger. What causes the crash is the structure's weakness. And here is what most people miss. Real danger doesn't show up during panic, but during calm. When sentiment cools off and traders let their guard down, that's when even a small rumor can shake the market hard. The key here isn't that the market moved on a rumor, it is why it moved so easily. The real fuel behind today's drop wasn't fear, it was leverage. 10x, 20x, even 50x long positions have been stacking up non-stop. In that kind of environment, even a tiny dip can trigger a chain reaction of forced liquidations. Once that domino starts, prices drop faster, more positions get wiped out, and the pressure snowballs. So, when the chart turns red, it's not always about who sold, it's about who got forced out. And here is what you need to remember. Market makers and whales can see liquidation zones. They know where liquidity is stacked, where leverage is concentrated, where stop losses sit. It's all visible in the data. So, with just a small move, they can crush the longs at key levels and the resulting liquidations push prices down even more. The broken levels are then filled with fear, and fear triggers more liquidation. If you go long without understanding this structure, just hoping the market will go up, you're setting yourself up to be liquidated. When the market feels calm, that's when most traders start using leverage lightly. But that is exactly when the game begins. Stay focused. The core conclusion I will share at the end connects directly to this structure. So, while crypto goes through this rough patch, what about the rest of the markets? At the same time, the stock market and AI sector are hitting all-time highs. Global capital is pouring into technology and productivity, creating record-breaking rallies. But crypto alone remains suppressed, and every recovery attempt gets cut short. If you think this is just because of bad news, you're missing the bigger picture. What's really happening is a structural decoupling. Residual liquidations from over-leverage, exchange load issues, strategic price suppression by whales and market makers, regulatory uncertainty, delayed liquidity recovery, all this acts as intentional pressure to slow the market down. But ironically, these kinds of compression phases usually appear in the middle of a bull cycle. When there is no clear narrative, the media goes quiet, and the crowd loses interest, and that's when accumulation becomes most efficient. So yes, the sentiment feels dual, but the structure, it's still quietly turning beneath the surface. Remember, the spots abandoned by impatient traders are always taken by someone else. Across the global stage, a quiet but massive shift is happening. The United States have weaponized the dollar through sanctions, pushing many nations to look for new ways to settle trade. It's not that sanctioned countries can't buy goods, they just find a different payment routes. And what is emerging in that space are gold and Bitcoin, neutral assets that no one can control. Russia has already allowed Bitcoin for international trade, and global firms like IBM are building institutional-grade digital asset custody systems. This isn't just a tech headline, it's a crack in the global monetary structure. Since 1971, the dollar-centric system has aged, and now the world needs a new form of collateral. Because governments, companies, and individuals all want money they can use without anyone's permission. The less trust there is in institutions, the more the market loses its center, and the more neutral assets gain power. This trend is not a daily headline, it's a multi-decade transformation. So the quiet movement we are seeing now carries meaning far beyond price action. What we are facing isn't just price volatility, it's the dilution of money itself. When the money supply expands, people don't notice, but their time and labor silently lose value. Doctors, engineers, teachers, they can't sustain their lives on their main job alone, so they turn to investing. As productivity drops and focus scatters, everyone becomes a half worker, half speculator. That makes society slower and more unstable. When survival requires both a job and financial literacy, the system is already unhealthy. And in that environment, the line between investing and gambling disappears. Stocks, altcoins, options, leverage, prediction markets, different faces, same rules. Winners design the risk, losers react with emotion. That's where Bitcoin steps in. Bitcoin isn't just technology, it's a mechanism to preserve time. It can't be printed, altered, or permissioned. That's why holding it long-term matters. Owning Bitcoin isn't only about profits, it's about claiming the right not to be diluted. Our anxiety doesn't come from markets, it comes from money disappearing faster than we can earn it. Many people fear we are already at the top, but the data tells a different story. There is no mania in the markets. Retail traders aren't chasing late entries, search volumes aren't exploding, media isn't euphoric, and RSI isn't overheated. This isn't random, it's a pattern that history has repeated. At true market tops, everyone is certain, everyone talks charts, and the media shouts a new paradigm. RSI stays right above 80, but right now we are nowhere near that. Prices are high, emotions are flat, attention is scattered, and the crowd is skeptical. That's not an end cycle signal, it's the calm before acceleration. Plan B's S2F model still leaves at least a 2 times room for growth at current levels. No model is perfect, but the key takeaway is this: absence of excess means room to build. This is accumulation time. In the end, price is just the shadow of sentiment. There are 2 things you must watch closely in this market. First, if RSI drops below 55, it's not just a pullback, it's a potential momentum break. Second, when the realized price and moving average start converging. Historically, when these 2 lines meet, it's marked the final stage of a cycle. If either of those triggers appear, it's time to turn defensive, reduce position size, set conditional orders, and define time-based stops. But as long as the market lacks excess and remains compressed, it's the kind of phase where patience pays off. Humans move by emotion, but markets move by data. The tighter the market feels, the greater the energy building underneath. In the long run, direction always sides with those who endure. When you connect every piece we discussed today, the conclusion becomes simple. Rumors and liquidations shake emotions. Structure shapes the cycle. And what we must always read is the structure itself.